So the next session is related to the next exercise. Exercise number 2 is related to the bank, which exists in the real life. And we are going to answer several questions based on the numbers which we will see, in this table. So what are those questions? So first of all, I want to know if this particular bank is asset or liability sensitive. So it is very much related to the first exercise which we did. And second one, I'm going to ask myself, is there an embedded optionality in the banking book of the analyzed bank? By the embedded optionality, what I mean. So do you remember in the interest rate risk webinar, I explained that there are explicit automatic options or implicit. So explicit or implicit automatic options embedded in the banking book. By this is very important aspect in IRRBB, which quite often before the Basel standard, Basel guidelines on IRRBB has been ignored for quite a lot. So basically those embedded options were never taken into account under the calculation of delta NII or calculations of delta economic value of equity. Instead, those options exist, and the last regulation is explicitly asking to include them into the calculation because it's obviously natural that we want to see them. And we want to see the real result. Otherwise, the result is not correct if you don't take them into account. So, as I said, we have two different parts of optionality. You have the automatic options and you have the behavioral options. By behavioral options, we mean the early withdrawal of current accounts. Clients, for example, client will have the option to withdraw the money earlier or whenever he wants on demand. And this is the option of the client on the client side. Behavioral option, because it's related to the behavior of the client. The bank in the same time have the option to change the interest rates on the current accounts product, on savings accounts, on current account, and can impose, let's say, this rate on the client. So the client receives the communication from the bank that from certain date, the rates applied to the current accounts is changed and will be increased or decreased. This is the option on the behavioral option on behalf of the bank, because the bank can decide and this behavior, change in the behavior. There is also the very famous behavioral option, which is prepayment, early prepayment, partial or full prepayment on the asset side. Once we are talking about the mortgages, obviously clients can prepay the mortgage, so can refinance it according to the expectation of the interest rates, or there are some statistical prepayment which are related to the changes in the status. For example, they inherited some money, so they want to prepay the loan. So there are different reasons for this kind of prepayment, and we are not analyzing them here. But the thing which is important, that all which I listed now are behavioral. Instead, in the banking book, we have also automatic options. Automatic options are the options which are absolutely rational. So you exercise them or not. if something happens, you always exercise them. If this event won't happen, the option will be not exercised. This is how it works, automatic options. And for example, in interest rate risk, we have quite common commonly seen the automatic options like caps, when you have the certain cap on the loan, or you have the floor on the loan. So imagine, let me explain yourself. So this is the option, interest rate option, which is now like IRO, interest rate option. So basically, imagine that you have the option, automatic option on the loan, corporate loan. And this automatic option is set up with the strike, so at the boundary, 0%. Now imagine that we are in the negative territory of interest rates, like in Europe, and the rates are negative, but you have this positive this option on the asset side, so the long option position, not positive, but long option position on the asset side. You have this floor, and these floors mean 0% floor applied to the asset side, to the corporate loan, which is implicitly embedded into their contract. You didn't buy them outright as an option, which you could do. It would be the outright position, and then it would be explicit automatic option. But in this case, when you have in the contract for the corporate loans this feature of the zero floor embedded automatically into the contract, we are saying that they are implicit. And those kind of options tell you that you cannot go, so your margin on the asset side cannot be squeezed more than 0%. So basically on zero, it is stop. So basically it cannot go down. So if, for example, the Euribor 3 months, your loan is indexed to Euribor 3 months, and Euribor 3 months is minus 0.50%, it means that you will get from your client still your commercial margin, full portion of commercial margin, which has been applied under the contract. So if the client pays you for Euribor 3 months plus commercial margin, even though Euribor 3 months is negative, you still get full extent of the commercial margin. Okay, this is a floor. And the same floor you can have on the liability side. Why? Because the same situation is related to depositors. Imagine that depositors, you need to pay some money to the remuneration to the depositors on their funding, because they borrow you the money. But imagine that the rates are in the negative territory. So basically, you should charge those negative rates theoretically on your clients. But given that you don't want to lose them, because if you apply the negative rate on your depositor, it means that you will charge them, instead of paying them, you will charge them money for keeping money in your bank. So they will tell you, no, we need to find the bank which won't charge us for the negative rates. So they will go rate shopping. At this rate shopping, in order to avoid this, banks prefer to have short option position on the non-maturing deposit, short option position with 0% floor or strike at 0%, which means that you basically won't charge to your clients the lowest rate you will pay. Your client receive is 0, so they don't receive anything, but at least they don't pay anything. So this is the obviously it creates for the bank the negative P&L, under the negative interest rates environment when they are getting even more negative. So when the rates are going down and down like right now, if you have big base of retail clients and you have negative rates territory, which luckily they are low rates but not negative in many countries, but in Europe we have negative rates. So obviously banks are already, this option is already exercised. So it's already working, it's executed because the rates are already in the negative territory. And in these cases, you will have this negative P&L impact coming from non-maturing deposits because the client won't be charged and your margin basically is getting squeezed because you cannot charge it down. So let's see what is, another question is, what is the variability of the net interest income? I will come back to this point. It's quite important point because we need to understand loss and variability. They are two different topics in IRRBB. So let's have a look at this behavioral table. Behavioral analysis, it means that all my non-maturing deposit assets and all items which needs to be modeled are modeled. So this is the behavioral view. So we are behavioralizing all items on the banking book and we are analyzing our IRRBB and the behavioral view. The opposite to the behavioral view is contractual view. And the contractual view, you will get everything, all items on the banking book exactly at the time contractual, where there is the contractual repricing. So contractual repricing for non-maturing deposit means that they are overnight instead of being modeled and split according to them between different time buckets. So usually, obviously, banks for managing IRRBB, they use the behavioral view. They don't use contractual view. This is why, because obviously a contractual view is it's only theoretical. We know that there are clients which are sticky, which will stay within the banks for a longer period, which won't withdraw the money too early. So it means that you have this fixed rate liabilities, or other jargon in interest rates is the structural liabilities, which can be used to offset the PV01 sensitivity on the longer time buckets. Okay, and this is why banks always monitor IRRBB under behavioral view, and contractual view is only for, sometimes the regulator is asking for the contractual view, or sometimes you do it in order to see what is the impact on the behavioral optionality on your IRRBB metrics. So this is like, it works by difference. You are trying to assess the all IRRBB metrics and the behavioral scenario, and then you do so under contractual view. So here we are assessing net interest income sensitivity under shock up. And you can see here that you will do it for assets and liabilities. So first thing which you need to ask yourself, this is the shock up or shock down? In this case, you see that this is the shock up. So it obviously means that on my asset, I will have the positive impact. I'm expecting to see the positive impact because obviously, when the rates go up, you will get more money on, more money in terms of interest for assets. So here you see that you have 4 million of positive impact when the rates go up on your cash position and central bank's reserve. You have also the treasury securities, 1.6 million impact. There is no interbank positions here. There is corporate loan. You can see some corporate loans here, which is 25. So it means that this bank probably has quite significant portfolio of the corporate loans, because there is 25 millions of sensitivity for those assets. So it means that's it's quite a lot. It means that it has quite a big portfolio of corporate loans. Now let's see what is going on the liability side. On the liability side, obviously I have the behavioral liabilities, and if you are charging, the rates are going up, it means that you will lose the money. Why? This is again one question which it's worth to think about. So the rates are going up. This is the liability. So for the bank, it means that I need to pay more on my liabilities to my clients, because obviously otherwise I will lose them. They will go elsewhere to shop for another rate. This is another thing. The same thing is for all other liabilities. So this is quite straightforward analysis. You can see the total is obviously summation of all those sensitivities, and the result is 22 millions, which comparing to the expected NII of this bank gives you the result of 89% versus positive income versus minus 13% limit. It means that this bank, in case of the parallel shock up, is going to earn money. So it is asset sensitive position, because the bank is earning money and the rates going up. So on the short part, I see the gapping period is 1 year. On the short part, the bank is going to earn 89%, which gives me two things. First of all, I know that the bank is asset sensitive, is going to earn money, so this is positive news. But there is also the negative news. There is quite significant, this number is big. This number, even though positive, is sensitive, is high. It means that 89% of expected NII, so double your NII, expected NII within the next year. If the rates go up, it means that the bank is sensitive, very sensitive to the interest rate changes on the short part of the curve. In order to understand the overall picture for this bank, you need to analyze its the same under the downward shock, because you need to see both. You need to see up and down. This is the same bank, the same items, and the same analysis, so NII sensitivity and the behavioral, but this is performed for the downward movement of the curve. So again, let's see what happens. The output means that, yes, for the cash central banks, I have minus 4 million. I expected this, because for those items, I'm applying the negative, the shift down, and obviously it's negative for the bank. But then I see that for the treasury securities, they're no sensitive to the rates going down. We know that place interbank, this bank doesn't have it, sorry. And for the corporate loans, we have very little move comparing with the situation under shock up. And the shock up, the same position was yielding me 25 millions or 26 almost. Meanwhile, under negative move, I have slight only loss of minus 2.3. So we have some revolving loans which are not sensitive as well, because we have zero position. So yeah. So my question is, why is so? And also, let's analyze. This is why I have this this question marks, because I want to understand why the sensitivity and the shock down is so different comparing to the same analysis up, because it's supposed to be symmetrical, right? Normal cases, it is symmetrical analysis. So you are waiting for them. Symmetrical outcomes, even though it depends on the extent of the interest rate. So I don't want to confuse you. If you have zero bound level of interest rates, then it can be not symmetrical. But let's focus now on the analysis for NII sensitivity. For the behavioral current account, savings account, because CASA stands for current account, savings account, so current accounts basically and savings accounts, which you have, we see that there is the positive impact. Obviously, the rates are going down. So it means that there will be positive impact to your client. Yes, there will be positive impact for the bank. And in case of corporate time depot, it's quite a little number, but it's symmetrical. Can you see? This is symmetrical. In case of the liabilities, it is not of the behavioral CASA, it's not symmetrical. So this is again something which you as a treasurer, you will know why it's so. So I will tell you why, because there is this automatic optionality here. So first of all, as I said, I cannot charge down to your client, retail client, the negative rates. So it means that this impact will be limited, will be much lower than in case of the movement up. Because obviously, probably this number is related to the wholesale current accounts or the corporates where I'm charging them the negative rates. So this is why when the rates are going down, my number is positive. But in comparison to the movement up, this number is much lower. Then let's have a look here. Corporate loans. Again, here there is some long option position in terms of floor, automatic option position, because I'm losing here to only 2 million in comparison to 26 million of gain when the rates are going up. So there is this floor which protects me against the further rates moving down. So this is euro, obviously, Eurozone bank, because you see it, numbers are in euro. So we are shocking the euro curve, which is negative. This is why you have those numbers. And there are the embedded automatic options, which are definitely working. So you have the automatic option on the corporate loans, which are floors with strike zero. At strike zero, it means that are already executed. And this residual amount of sensitivity is probably related to another currency, because it's overall denominated in euro, but all currencies taken together and shocked with, so other currencies which don't have, this floor, or other loans which don't have these floors are here in this analysis. And you can see it, but definitely the euro one has some automatic floors, because otherwise those difference is so big. So 26 millions positive impact on asset under shift up, and only 2 million loss under shift down. It means that there is definitely this zero floor. Then overall, you have the negative number, which is minus 2 millions. This number obviously is limited because of the floors. So in case the floors were removed, obviously you can imagine here you would have minus 26 millions. So then you would definitely breach this limit. But given that you have these floors, they are working nicely, they are executed, you have the impact, the negative impact of minus 8.6 because due to this cash. As I said, in IRRBB, if you expect the downward movement of the curve and you are piling up huge amount of cash or central bank reserves, which are obviously excessive because you are obliged to keep your counterbalancing capacity high because of the liquidity, in case of the liquidity stress. So I'm here saying any excess cash is not working well, is not helping to your IRRBB positioning. So this is basically the result. So yes, there is a high variability in terms of NII sensitivity on the, as you can see, this 89% and the shock shock up. There is 1-digit number sensitivity under shock down because of the automatic options which are here embedded. So here you won't see those options if the rates were not negative. But the rates are negative and then they are working, already executed. This is why those numbers are so different. Otherwise, you could expect the symmetrical numbers, like you can see, for example, for the cash. The cash and the positive, it's 4 million. And the negative scenario, you lose 4 million. It is symmetrical. The same corporate time depot, but it's not the case for other items which have some automatic options embedded. So this is the end of the second exercise.